Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing United Microelectronics stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 20 billion market cap. They're trading at $8 a share and they have 2.6 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The numbers looked really good. From 2020 it was 1.2 billion up to 2 billion in 2022. Then they posted a negative in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That went from 700 million up 300% to 2.9 billion. Then it's down to 2.2 billion in the trailing 12 months. But you could see they had negative free cash flow, but a big profit. So they're investing a lot back into their business through CapEx. Revenue is the sales for the company, and that grew a lot from 2020 to 2022, almost 9 billion. Then it dropped in the trailing 12 months to 7.5 billion. They report all their financials in new Taiwan dollars, but I converted the numbers on my Excel spreadsheet to US dollars since we're looking at the ticker that trades in the US. When we look at their financials later in their reporting, it will be in new Taiwan dollar. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 29 billion. We discounted the numbers back to today's weighted average cost of capital. We get a value of the company of $25 billion. We divide that by 2.6 billion shares. And we get a calculated stock price of $10. They're trading at $8, so they're trading at a 20% discount. It's a buy according to the model. Their future free cash flow growth seems achievable. I'm expecting their free cash flow in 2023 and 2024 to be less than 2022. 2025 to be equal to 2022, and then finally to surpass it in 2026. And based over the company's revenue projections, I definitely think they can do this. There are 62 companies in the same industry as UMC, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. So they only have blue numbers, so they're better than the median in every category. They spend a lot on CapEx, 3.6 billion, a good debt to equity ratio of 0.2. For every dollar of equity, they only have 20 cents of debt. They pay a massive dividend of 7.4%, the biggest by far on this list. They generate a good amount of free cash flow, 1.4 billion, more than the median average. They rank 17th in market cap. Really solid price multiples, a 1.8 price to book, a 12.2 PE, below 15 is amazing, 15.2 price to free cash flow, and a 2.9 price to sales, so it looks really attractive. They generate lots of revenue, 7.2 billion, more than Marvell, and Marvell is almost triple the market cap. And they're still growing. Their 5-year annual revenue growth rate is 11%. Let's take a look at their financials. This is their income statement. And they show the numbers in US dollars and new Taiwan dollars. So revenue in the third quarter of 2023, 1.8 billion, down from 2.3 billion. The expenses tied to generating the revenue are 1.1 billion. So gross profit 630 million, down from 1.1 billion. Margins are also down quite a bit, from 47% to 36%. Operating expenses of 177 million US dollars, down a little from last year. So operating income 475 million, last year 900 million. Their operating margins are down quite a bit as well, from 40% to 27%. Net income $500 million, 28% net profit margin. To calculate net profit margins, net income 495 million over revenue of 1.8 billion. That's how you get the 28%. It's down from 36% last year. And their EPS, earnings per share, are 4 cents compared to 6.8 cents last year. Their earnings per ADS, American Depository Share, is 20 cents because 5 of the company's regular shares is equal to 1 ADS. It even says that down here, 1 ADS equals 5 common shares. Their shares outstanding are up a little bit, 12.3 billion to 12.4 billion. Let's look at their balance sheet. Current assets of 6.8 billion, current liabilities of 2.9 billion. So their current ratio is well above 1. It's actually above 2. Total assets 17 billion. Their biggest asset is property and equipment, 6.6 billion. They have $4.3 billion of cash on their balance sheet. Liabilities of $6.1 billion. Their biggest liability is accounts payable is $1.6 billion. This is when they buy on credit, so they owe this money to their vendors. And equity is assets minus liabilities, that's $10.9 billion. They raised $3.9 billion from selling their business. They profited $6.5 billion from running their business. Retained earnings is the sum of all their prior net incomes minus the sum of the dividends they paid out. Let's take a look at their statement of cash flows. This is for the trailing 9 months. Operating cash flow $1.9 billion. Investing cash flow negative $2.2 billion because they spend a lot in CapEx, property, plant, and equipment, $2.2 billion. In their financing section, you can see their dividends they paid out, $1.4 billion. Here's their stock price since they started trading in 2000. It started off decently. It did go down, then it came back up to about $8. Then from 2002 to 2020, the stock pretty much went nowhere. Just before mid-2020, it got real low. It looks like below $1.50. It's hard to know when these stocks will pop. This looks like a rocket ship. Look how fast it went up. Well past $10, up to $11. You could have 10x'd your investment in just a few months. In April of 2020, it was $2. And then a year later, April of 2021, it was $10. It hit its highest point ever in September 2021. I think there's a good chance it's going to break through $12 again this year, because semiconductors are hot, especially with AI. Look at their EPS growth since 2018. It went from 10 cents to 13 cents to 41 cents, doubling to 82 cents, up to $1.19. Their sales were steady from 2018 to 2019, then growing at least $1 billion a year into 2020, into 2021, and then into 2022. And their shares outstanding are pretty steady. They did go up from 2018 to 2020, but then flat after that. Let's look at the company on Simply Wall Street. Its last price, $8, $20 billion market cap, down 2% in the past week, up 6% in the past year. Let's see what they say about the company. UMC operates as a semiconductor wafer foundry in Taiwan, Singapore, China, Hong Kong, Japan, the US, Europe, and internationally. They provide circuit design, mask tooling, wafer fabrication, and assembly and testing services. It serves fabless design companies and integrated device manufacturers. Broadcom, Nvidia, those are examples of fabless companies. Those companies outsource their manufacturing to companies like this. They were founded in 1980. They're headquartered in Hsinchu City, Taiwan. Simply Wall Street's valuation is $6. They say the stock is 32% overvalued. You can see their revenue is projected to grow a lot the next few years, up to 325 billion new Taiwan dollars. And that's equivalent to 10.5 billion US dollars. 59% of the company is held by the general public, 31% by institutions, 5% by private companies, 2% by public companies, 1.5% by employee shares, and a little over 1% by insiders. The biggest shareholder is BlackRock at 3.8%, then a Taiwanese hedge fund at 3.5%, and there are a lot of different shareholders, Goldman, JP Morgan. Their employee count is pretty steady, 18,000 in 2015, 20,000 in 2019. The ticker trades on the Taiwan Stock Exchange, New York Stock Exchange, Deutsche Börse, and Mexican Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.